Good evening, students. Hope you are doing well. Hope your studies are going well. Yeah. So, have you done Companies Act taxation, companies taxation, the tax rate, what it is applicable? Because today, what we are going to start with is the assessment of various entities class. So, have you done with the tax rates which are applicable to the different companies? If you have done, please let me know what are the different tax rates which are applicable to a company. Because first we are going to start with respect to the company taxation under the assessment of various entities. So yes, what is the tax rate applicable to a company? Yes, please tell me, students. Yes, please faster. Have you done with the tax rates what are applicable to company? Yes, good evening, Satish. Good evening, Ginny. Yes, students, please tell me what are the tax rates? Have you done or have you not done? Yes?
On companies, it is a 25% tax rate applicable.
Okay. And what, so there are multiple tax rates. What are the different rates? What are the different conditions? Have you done this topic in the basic concepts or have you not done it as yet?
Yes, मैम बेसिक कॉन्सेप्ट्स में मैम ने कराया था.
कराया था ना, right? So what are the different tax rates which are applicable? Yes, students. Yes, please. Okay, let me tell you first of all what are the different rates which are applicable. So basically, there is a general tax rate of 30%, isn't it? Then there is a 25% tax rate which is applicable where the turnover or the gross receipt does not exceed 400 crores, isn't it? In which previous year? In previous year 22-23. So the one tax rate which is general tax rate is 30%. Secondly, it is 25%, where the total turnover or the gross receipt of the previous year 2022-23 does not exceed 400 crore. Do not see the turnover or gross receipt of 23-24. It is of 22-23. Isn't it? Then what are the two concessional rates which are applicable? Does anyone remember? There are two concessional sections which are applicable, optional sections, where you can exercise the option and opt for a concessional tax rate. Any idea?
Ma'am, 115 BAA and 115 BAB.
Very good, yes. So 115 BAA and 115 BAB provides for a concessional optional rate of tax. 115 BAB, which is there, provides for concessional rate of 15% plus the surcharge of 10% and cess of 4%. Right? So that is applicable to manufacturing or electricity generating domestic companies set up and registered on or after the 1/10/2019 and which commences the manufacturing or electricity generation before 31st March 2024. Right? This is only applicable to the manufacturing or electricity generating companies. Isn't it? The 15% plus 10% plus 4%, which makes it to 17.16% rate. Right? So this particular company should not be engaged in any business other than the business of manufacturing or production or the generation of the electricity. Right? So there are certain exclusions which are given under that development of computer software, mining, conversion of marble, printing of books, bottling of gas. These are not considered as manufacturing operations. And then this particular entity should should have been incorporated post 2019, 1st October 2019, and should commence the manufacturing or production of an article or thing before the 31st March 2024. Isn't it? It should not be formed by splitting up or by reconstruction of the existing business. It should not use any second-hand plant and machinery. But there is an exception if the plant and machinery is imported and that second-hand plant and machinery is less than 20% of the total plant and machinery. In that case, it would not be considered as a second-hand plant and machinery. Isn't it? Now, there are certain conditions with respect to which you will have to follow, wherein you will have to give up the claims on certain expenses, on certain deductions which are specifically allowable. Only then you will get this 15% or this 17.16% rate. Next section was 115BAA, which is applicable to any domestic company. What was the tax rate? 22% plus surcharge of 10% plus the cess of 4%, which makes it to 25.168%. Isn't it? Now, again there, you have to forgo certain deductions. There are no other conditions unlike 115BAA, but here you have to forgo certain deductions and only then you will be taxed at 25.168%. What are the deductions? For example, 10AA, which is exemption of profits from the export of articles if the unit is an SEZ unit. Additional depreciation on the plant and machinery of 20%. Deduction for the tea, coffee, rubber development under 33AB, 33ABA. Then scientific research expenses. Deduction of payment to the National Laboratory for Scientific Research. Investment linked deductions under 35AD. 80C to 80U deduction, which is basically in relation to the profit linked deductions also, right? ATIA, ATIB, all of that. But which other deduction you will get? It is ATJJAA for the employment or ATM, which is for the intercorporate dividend. We have done ATM in the income from other sources class, right? So once you forgo these deductions, then you will be able to claim either the concessional tax rate under 115BAB or under 115BAA. In case you fail to satisfy the conditions, then the option would become invalid and the normal tax provisions will be applicable. Are we clear? So if you fail to satisfy any conditions under 115BAB, you can still go for 115BAA. If you fail to satisfy the conditions under 115BAA, then in that case, the 30% tax rate will be applicable. Here, the MAT is not applicable. In these cases, in the 115BAA and 115BAB, the MAT is totally not applicable. Here, you have to exercise the option under 115BAA, BAB, sorry, before the first return of income is filed. And in case of the option once exercised, then that option will prevail for the subsequent years. And if a person fails to exercise the option, it cannot be exercised for the subsequent year. So you have to do it in the year of incorporation itself. Are we clear? So you cannot come out of it. So once you exercise the option, it cannot be subsequently withdrawn. Similarly, under 115BAA also, once you exercise the option, it cannot be subsequently withdrawn. But there, it has not to be done in the year of incorporation. There, you can do it in the any year. Okay? So, this is basically the tax rate which is applicable. Now we move on to specifically the minimum alternate tax, right? So just write down over here. Assessment of various entities. So the first provision that we are going to discuss is minimum alternate taxes. Any idea what are minimum alternate taxes? Yes. Any idea what is this? So see, in case of the companies, right? What they used to do is they used to show genuinely some losses, right? These companies used to claim a lot of losses and will never pay any taxes, even though they may have the book profits, but in the tax, they will show the tax losses. And they still used to give a lot of dividends to the shareholders. See, when you have a loss, you are not able to declare the dividend. But still, these companies were declaring dividend, even though they had loss, which means they had the book profits, right? So that is why this minimum alternate tax concept was introduced. So minimum alternate tax concept, which is based on that a company should be paying at least a minimum tax which is there, so that there are no zero tax companies. So the objective of the MAT was to cover the zero tax companies that were not paying taxes despite having profits and despite making the payment of dividends to the shareholders. That was the rationale behind introduction of the MAT. So MAT was introduced to ensure that there is a minimum taxation which is paid by all the companies. Are we getting that particular point? So this MAT concept which was introduced is applicable if the income tax on the total income, if the tax on the total income is less than 15% of the book profit. So if the normal tax is less than 15% of the book profits, in that particular case, the MAT will get attracted. Have you understood why the MAT is first of all applicable? So the idea or the rationale behind that was that this is because the companies were paying the zero taxes. So in order to avoid those kind of companies, this particular MAT concept was introduced. If my tax under the normal provision is less than 15% of my book profits, then in that particular situation, students, the book profit shall be deemed to be the total income of the assessee. So in this case, book profits shall be deemed to be the total income of the assessee. If my normal tax is less than 15% of my book profits, then book profits shall be deemed to be the total income of the assessee. And then the tax will be payable on by the assessee only at the rate of the 15% plus applicable surcharge and applicable cess. What is the rate of surcharge, students? What is the rate of surcharge? Yes. You have done this particular point also in basic concepts. You can't forget these things, students. What is the rate of surcharge for the domestic company? Yes. Answer, students, please. Yes. Students, please answer. How would I know if you know that, if you don't know that? Yes, Satish. It's not 2%, Satish. That is for a foreign company. For the domestic company, what is the rate of surcharge? Yes.
Ma'am, up to 50 lakh, it is 12%. Oh, sorry, 10. It is 10%.
For the domestic company, Jini. What is the surcharge for the domestic company? That is for the individuals. For the domestic company, what is the surcharge? Yes. Students, this is the basic question in the basic concepts class. Yes, Satish Kumar, you're right now. So it is 7% where the total
Yes,
income exceeds 1 crore and is less than 10 crore. And it is 12% if the total income exceeds rupees 10 crores.
crores.
Yeah.
Yes, ma'am.
Okay. So basically, see, students, now you are coming to the end of the computation questions, because this is the last topic, assessment of various entities, which is going to cover your entire computation questions. After this, you will be starting up with the classes like TDS, TCS, assessment procedures, appeals and revision. So those kind of classes will not have any relation to what you have done under the computation. So as far as your computation questions are going to be asked, it is either going to be from PGBP or it is going to be from assessment of various entities. There could be a question on capital gain, right? So you have to be very thorough with these 5 heads of income. You cannot be forgetting any provision, because this is very, very important. One mistake you will make, students, it will cost you the entire sum sometimes. So you have to remember these basic provisions. Surcharge kya hai, cess kya hai, tax rate kya hai. You cannot be doing any mistake in these questions. Then, so we have to remember. I would suggest before our next class, please start revising the basic concepts that you have done so far, what you have done under the PGBP so far, right? Because otherwise, what would happen is you will tend to forget everything by the time you will come to the end of this class also. Okay, so all of you will please revise everything.
Yes, ma'am.
Okay, yes, perfect. So basically, here my book profits shall be deemed to be the total income, and the math which is applicable here is 15% plus surcharge and plus cess. Are we clear? What is the surcharge for the foreign company? Yes. What is the surcharge for foreign company, students?
Ma'am, 2% up to 10 crore and 5%
Yes.
after 10 crore.
Yes, absolutely. So it is 2% and 5%. Okay. So 2% up to 10, 5% beyond that, isn't it? So that is for the foreign company. Now, question is whether MAT is applicable to the foreign company. That's the question you should ask, right? So to whom MAT becomes applicable? MAT is equivalently applicable to a domestic company as well as to the foreign company also. MAT is applicable to both. So here you can write down applicability of MAT. It is applicable to the domestic company. It is also applicable to the foreign company, right? It is MAT which is there is applicable to a domestic company, but there are certain exclusions in both of these. Now, what is exclusion with respect to the domestic company? Yes, so to which company MAT will not apply? Let me see who gives me the answer. Yes, to which company MAT is not applicable? We just now discussed. Yes. To which company the MAT will not apply? We just had a discussion. Yes, Satish Kumar, very good. To the companies which are opting for 115 BAA and 115 BAB. Right? We just now had a discussion, students. The companies which are opting for 115 BAA and 115 BAB regime, to them, MAT is not applicable. Isn't it? We just had a discussion, yes or no? Yes. Again, basic concepts revision. MAT is not applicable to the companies which are opting for 115 BAA, opting for 115 BAB, and thirdly, the life insurance business. So basically, the companies which are undertaking the life insurance business, if they have any income accruing or arising from life insurance, the MAT will not be applicable. Are we clear up till this point or not? Yes. Students, whoever are participating, please be there with me. Please participate in the class because it is very essential for you to understand these concepts. And only when you make mistakes, you will be able to solve that mistakes. Right? You will be able to remember that in the exam. So all online Zoom students, both please participate in the lecture. As much as you participate, it would be better. Okay. So this is as far as the domestic company is concerned. Similarly, for the foreign company also, there are certain exclusions. What are the exclusions? For the foreign company, the exclusions are if the foreign company is a resident of country with which India has a tax treaty, right? If the foreign company is a resident of country with which India has a DTAA or the tax treaty. And it should not have a permanent establishment in India. It should not have a permanent establishment in India. I'll explain this. Or a foreign company is a resident of country with which India does not have DTAA. India does not have DTAA, and it is not required to seek registration under the company law. Now, let me explain this particular point with respect to the foreign company. See, a foreign company is a resident of a country with which India has a DTAA. Any idea what is a DTAA? DTAA is basically double tax avoidance agreement. This is an agreement which has been entered into to eliminate the double taxation which occurs between the two countries, because one country is taxing it because I'm a resident of that country. Other country is taxing it because I have an income arising in that country, right? So there is a DTAA, an agreement signed between the two countries to avoid the double taxation when the income is earned from more than one country, right? So if the foreign company is resident of a country with which India has a DTAA, right? And it does not have a permanent establishment in India. Now see, permanent establishment, students, for now, what you can understand is permanent establishment means branch. You can write in simple language. See, it is not something, the meaning of it. I'm just giving you for your reference that it means a branch. In simple words, it just means a branch. So if a foreign company does not have any branch in India, if a foreign company does not have any branch in India, the MAT will not become applicable to it. Very straightforward. So if a foreign company is a resident of country with which India has a DTAA, and this foreign company does not have a branch in India, so this is what you will understand the meaning for now. Okay, you will understand it in the international tax class, what is a permanent establishment and all of that. For now, you have to understand like this. Are we clear? So in that particular case, the MAT will not become applicable. So P for this matter is just nothing but a branch. Fine? Yes or no? Secondly, if a foreign company which is there, it's just not coming from a country with which India has a DTAA. And in that case, the condition which is there is that it is not required to seek any registration under the company. Okay, so it is not required to seek any registration under the company law which is there. I am not required to get registered over here in India. In that particular case, the MAT will not become applicable to me. Clear? Third scenario is, sorry, foreign company.
मैम इन दोनों पॉइंट्स में डिफरेंट नहीं समझ आया, डिफरेंस क्या है?
Sure. See, the difference in these 2 points is, in this first point, it is coming from a country which has, with which India has a DTAA. In second point, it is coming from a country, the foreign company is a resident of country with which India does not have a DT. Are you getting this? So let's say
Yes.
for example, इंडिया ऑस्ट्रेलिया हो गया, उसका DTAA है, तो एक फॉरेन कंपनी अगर ऑस्ट्रेलिया की रेसिडेंट है, so in that particular case the condition is that it should not have a branch in India. Otherwise, if it has a branch in India, MAT will become applicable. But let's say India, Bermuda, India, Cayman Island, there is no DTAA. So उस केस में we will check the second condition, that it's a resident of a country with which India does not have a DTAA. So therefore, it should not require any registration under the company law. Okay. So if it is not required to seek any registration under company law, MAT is not applicable. Are we clear?
Yes, ma'am.
Okay. Perfect. Third point is, if it's a foreign company, MAT will not be applicable where the total income is comprising solely of the profit and gains, which has total income, comprising solely of profits and gains, solely as profit and gains from business such as, which is covered under 44B, 44BB, 44BBA, and 44BBB. क्या था ये तीनों sections? चारों sections in fact. What were these sections? Have you done these sections? Under PGBP, have you done these sections? Yes or no? At least say yes or no. Have you done or not? Yes, students. Have you done these sections or not? Yes or no? You don't remember whether you have done these sections or not. Yes, Satish is saying yes, so means you have done it. What is 44B? What was 44B? These are presumptive sections, students. 44B is profit and gains of shipping business. 44BBA was profit and gains from the business of operation of aircraft. 44BB was profit and gains in connection with business of exploration of mineral oils. 44BBB is business of civil construction, turnkey power projects. Have you done these sections or not? Or is it pending? Now do you recollect? At least give me a yes or no in chat box. Yes, you have done. So you don't remember, which is wrong. At least you should have an idea. Even if you don't remember the percentages, that is fine. Right? So therefore, in these cases, if the foreign company has the income from these presumptive sections, which is from the shipping, aircraft, exploration of mineral oil, turnkey projects, in those cases, the MAT will not be applicable. Are we clear about the applicability of MAT? Yes or no? Yes, any questions so far? Okay, so let's proceed then further if there are no further questions. Now, as I said, your book profits, if you have the tax under the normal provisions lesser than the 15% of book profit, then in that particular case, the book profits shall be deemed to be the total income, and MAT under 115JB will be applicable at the rate of 15% of book profit plus surcharge plus cess. Isn't it? Now, in the case of the units in the IFSC, this rate is 9%. Okay. For others, it is 15. For units in IFSC, it is 9. Additionally, book profits, as I said, are deemed to be the total income, which means you have all the provisions which are applicable to a total income being applicable here, which is advance tax, right? Interest under section 234A, B, C. All of this will become applicable if you do not pay advance tax on time. If you file your return late, then 234 ABC will apply on the book profits which are there, the tax on the book profit which is there, basically on the MAT. Because book profits are deemed to be the total. Okay. Now let us understand what is the book profit or what are the book profits. So computation of the book profit. So see, MAT is an independent code in itself. Right? MAT is an independent code in itself. It is a code which is completely saying how to compute the book profit. Right? So therefore, in that situation, there is no look away from the MAT provision. Right? So basically, for example, till now you have done the heads of income. So every head of income is giving a particular way to compute the book profits, to compute the total income, right? For example, under PGBP, you have certain set of allowances, certain set of disallowances. Okay. So basically, in that particular case, you are following the code which is given under the PGBP. In case of capital gain also, it was the same thing, right? So in that particular case, there is a possibility that you have the every set of income covered under different. Here it is nothing like that. Here, what you have to do is, here it is not about the heads of income. Here it is like a complete code which is given as to how do you calculate your book profits. You don't have to go to multiple heads over here. This particular provision which is there under 115JB will give you the way to compute the book profit. Okay. So in that particular case, this MAT provision or the MAT chapter which is there under 115JB section which is covering that, there everything is given and beyond that you don't have to look into. So you have to compute as per this provision itself, which is 115JB. So book profit which is there, the book profit which is there is the profit as per the profit and loss account prepared as per the Schedule 3 of the Companies Act 2013. Right? So, here I will start with the net profit as per the profit and loss account as per the Companies Act 2013. Then I will add or less multiple things over here. Number one, add income tax. So you have to remember these provisions. See, it is very different from the computation of the normal total income which is there. Right? So the first provision here is income tax. Now with respect to the income tax, you will add back the provision for tax or the actual income tax paid or payable, interest, surcharge, cess. Everything gets added over here. So basically, provision for income tax, income tax, paid or payable, interest on income tax, surcharge, cess. All of it gets added over here with respect to the income tax. Isn't it? It will also include the deferred tax which is there. So we will add back even the deferred tax which is there. What is deferred tax, students? What is deferred tax, students? You can write here add or less adjustments as per explanation 1 to section 115G. This is to be added. What is deferred tax, students?
Ma'am, when there is a difference between the book value of profits, book profits and profit computed as per income tax.
Yes. Vignesh, you wanted to attempt?
It is a tax effect on temporary differences arising on the difference between the book profit and accounting profit. Sorry, book
Yes.
profit and tax profit.
Yes, absolutely. So the deferred tax is the difference which is arising in terms of the timing differences or permanent differences which are arising with respect to what? The differences between the income tax and the book profits which are there, right? So any deferred tax which is added or reduced from the book profit, right? We make a provision for the deferred tax in the P&L account. So that has to be reduced or added. So if you have considered the deferred tax provision, you add back. If you have any deferred tax credit, if you have reduced it, then you have to add back that particular amount. Right? So deferred tax is to be removed. So basically add or less the deferred tax, depending on whether you have a debit or the credit. Okay, so you can write the deferred tax credit. Fine. Here, remember one thing. Penalties are not added. So under 37, when you do the normal computation, students, you add back the penalties which are paid. Isn't it? Under normal provision, 37 says that any fine, any penalty is disallowed. But here, under the book profit calculation, penalties will not be added back. As I said, the book profit computation will be as per the 115JB section only. It cannot be as per the normal provisions of the income tax. You don't have to look beyond these adjustments. It's very specific, precise adjustments which are there. Are we clear? So this is the step 1, which is with respect to the income tax. The second one which is there is basically the amount transferred to the reserves. So amount transferred to the reserves. Are we clear? Now with respect to the amounts which are transferred to the reserves, what adjustment we will make over here? So amount which is, let's say, credited or debited to the P&L account. Let's say we are debiting any amount which is carried to the reserves. Or for that matter, if let's say, for example, we have made any revaluation reserve. right? So we are debiting or crediting that amount. So amount which is standing in the revaluation reserve relating to the revalued asset. So all these amounts again are to be ignored, are to be added back. Similarly, any amount which is withdrawn from any reserve, if the same is credited to the P&L account, then also you will reduce the amount. If amount is withdrawn from the revaluation reserve, so again you will add back that amount, or sorry, reduce that amount. So add amount transferred to the reserve, which is debited to the profit and loss account. Right? So that we will add back, including any amount which is made towards the transfer of the revaluation reserve. So here you can just write down including the revaluation reserve, and you will less the amount withdrawn from the reserve, which is credited to the profit and loss account. Are we clear? Number 3 adjustment. Now this was very simple, right? Number 3 adjustment is provision for the liabilities. So provision for other than ascertained liabilities. Provision for unascertained liabilities. What do we understand by unascertained liabilities? Yes. What do we mean by that, students?
Liability which amount cannot be determined.
Okay. Can you give an example of that? Okay, let me give you examples and you tell me whether this provision would be allowed or not.
Whether it is contingent liabilities?
No, see, contingent liabilities ka provision we never make. That we show it as a footnote for the financial.
Yes, ma'am.
Right? For the provision, let's say, for example, provision for the gratuity. Whether a certain, uncertain liability.
Certain, ma'am.
Certain? Yes. Anybody thinks it's uncertain? Yes, please.
Ma'am, depend. It's a defined plan or it's a defined contribution.
Okay. Yes. So, see, if the amount is determinable, if it is in a way the amount is fixed, it is something that there is going to be, that only this much amount is going to be incurred by us, then in that particular case it can be considered as a certain liability, right? So where the liability is fixed, right? The liability is fixed that I have to pay this much expenditure only. There is no deviation in that. Then in that particular case, we can say that the provision which exists is for the ascertained liability. However, where the liability is not at all fixed, where you do not know as to how much is going to be payable, you are just making a provision at this moment. You are not sure as to what would be the payment or what would be the outgo which is going to be there. Then in that particular case, it is an unascertain liability. So where the liability is certain and is also capable of being quantified, then such liability is considered as the ascertained liability, liability in present time. If the liability is uncertain or is capable of being not quantified, then in that particular case, that provision will not apply. So this is a similar provision which also exists under section 28. If you look under section 28 of the Income Tax Act, what does it say? It says profits or gains arising from the business of profession carried out during the previous year. What do we understand by during the previous year? That means that the expenditures will be allowed only for the expenditure which are incurred during the previous year and not of the expenditure to be incurred in future. Isn't it? So therefore, we do not allow the provisions under the normal provisions also under section 28 or under the head PGBP. If you look at ICDS 10, students, see the linkage over here. This is how you have to link in your mind also. If you see ICDS 10, what is ICDS 10, students? What was ICDS 10? Yes, what was ICDS 10? Yes. ICDS 10 was what?
Ma'am, contingent liabilities.
Yes. Contingent liability, provision, contingent asset. So ICDS 10 also tells you. What does ICDS 10 tells you? That recognize a provision only when the person has a present obligation as a result of a past event. It is reasonably certain that there will be the payment which will be made. There will be the settlement of the expenditure. And I can quantify that amount. I can make a reliable estimate of the obligation. Once these three conditions are satisfied, that there is a liability, there is a present obligation to clear that liability, there is a reasonable certainty that there will be the outflow of resources, and a reliable estimate can be made. Only then the provision will be recognized. Otherwise, it will not be regarded as the provision for the ascertained liability. What are the examples of ascertained liability? Provision for warranty charges. It's very common for businesses which are in electronics to recognize the warranties which will be arising, right? Because at any point in time, what they do is based on the past event, they calculate that what will be or how much are the chances that the repairs will come. How much are the charges that these warranties will be invoked? They have that kind of calculation based on the past event. They do this probability calculation. So provision for warranty charges is an ascertained liability because it is based on a reasonable calculation of the past event. That past may, let's say 100 TVs I have sold, out of 100 TVs, 10 TVs were always coming for repair. So I will recognize the warranty provision for that. Isn't it? Provision for gratuity. again it is an ascertained liability, because the calculation of the gratuity is done based on the actuarial valuations. So the actuary comes and values that particular thing, that how many gratuities would be paid. So therefore, these are the ascertained liabilities. And therefore, those will be not disallowed under the MAT provision. But if you see 40A9, under normal provision, 40A9 disallows the provision for the gratuity. Isn't it? 40A9 of the Income Tax Act. There, it is not allowable deduction, isn't it? So even though this is an ascertained liability, but under income tax, under normal provision, under the head PGBP, if you go to 40A7, 40A9, the provision for gratuity is not allowable. So that is under the PGBP. Under MAT, it may still be allowed. Under MAT, it will not be disallowed. So under the normal provision, if in a question which comes that you have to do the MAT calculation as well as the normal tax calculation. See students, be very attentive. There can be a question in exam where it is given contribution towards an approved gratuity fund. You will disallow under the normal provisions under 40A7. Under MAT, you will not disallow. Are we clear about this? Yes or no? Right? So you can write it over here. This is an ascertained liability. Under MAT, this is allowed. Whereas under PGBP, disallowed 40A7. Clear? So you can write down, this is only for the unascertained liability. Add back, provision created, and less amount credited, if any. Are we clear about this? Yes or no? Okay. Now this is with respect to the provision for the unascertained liability. Next is the provision for the losses of the subsidiary company. So that has to be added back. So provision for the loss of subsidiary company, this we need to add back. Next, provision with respect to the diminution in the value of asset. Again add back. Right? So any provision for the diminution in the value of asset, we need to add back. So provision for the unascertained liability, provisions for the losses of the subsidiary company, provision with respect to the diminution in the value of the asset, all are to be added back. Are we clear? Next is dividends. So dividends paid or proposed, again add back. Okay. So dividends paid or proposed, we will add back. Next is depreciation. Now with respect to the depreciation, see, under normal provisions, what do you do? Under normal provisions, what do we do? You add back the depreciation as per the books of accounts and reduce the depreciation as per the Income Tax Act. Isn't it?
Yes,
Here
ma'am.
you don't have to do anything of that sort. So, under the normal provisions, you are correct. We'll add back the depreciation as per the books of accounts and we'll reduce it as per the normal provision. Here, we will add back the depreciation as per the books of accounts, which will include the depreciation on the revalued asset. Less depreciation as per not income tax, as per books of account, excluding the depreciation on revalue asset. So see students, in effect, what I'm trying to do is, I am trying to just add back the depreciation on the revaluation of asset. So in effect, depreciation on revaluation of asset is added back. So you don't have to reduce the depreciation as per income tax. Here you have to reduce the same depreciation, but first you have to include the depreciation on revalued asset. In the second case, you have to exclude that. So basically, you are just adding back in effect the depreciation on revaluation of asset. But this is how the presentation is, and you will have to do it in that manner. Are we clear? Yes or no? Fine. Now, next is, yes, Jenny.
No, ma'am, it is by mistaken.
Okay, no problem. So next one is income which is exempt under section 10, 11, 12. Now any income which is exempt under 10, 11, 12, if the amount is credited, so basically you will reduce it, and any expenditure you will add it. Expenditure on the income which is exempt less income which is exempt, if it is credited to the P&L account. Are we clear? Now, next one is the share of the assessee in the income of the AOP or BOI. Share of the assessee in the income of AOP or BOI. So see students, this we will learn when we will do the AOP or BOI taxation in the coming class. But for now, I'm just wanting you to write down that the amount of the share of the assessee if he is a member in the AOP or BOI, on which if there is no income tax payable as per section 86, then that amount will be reduced and the expenditure will be added back. So basically you can write down less the share of assessee who is the member in the income of AOP or BOI on which no tax is payable under section 86 and add back any expenditure in relation to that income. Are we clear? So don't think much about it at this stage. We are going to discuss about this in the coming classes where we will discuss about the AOP or BOI. Then gain on the, or you can write down notional gain on the units of business trust. So again, here I will say for the time being, do not focus on this. Again, we will discuss when in the coming classes when we'll be discussing about the taxation of the trust. Okay, so there we will come up with this particular point for sure. So you have to reduce any notional gain on the transfer of shares of SPV to a business trust in exchange of units allotted by business trust. Right? Add back notional loss on the transfer of shares of the SPV. Right? K is the actual gain or loss on the units of the business trust. So in the first case, we are reducing and adding the notional gain or loss. In the second case, we are allowing the actual gain or loss. Do not worry, we are going to discuss that. You can just write over here. Please refer the class on the taxation of trust. So add actual gain on the transfer of units acquired in exchange of shares of SPV. Less actual loss on transfer of units. Are we clear? Next is royalties. Royalties taxable under section 115 BBF. What is 115 BBF? Any idea? Any idea what is 115 BBF? Okay. See, there's a specific concessional tax rate which is applicable in case of royalties arising from the patents. So where a person who is a resident in India. This is only applicable to a person who is resident in India. If he has income by way of royalty in respect of a patent developed and registered in India. So the patent should be developed and registered in India. In that case, the royalty income will be taxed at the rate of 10%. Now see, what will happen if this royalty income is not reduced from the book profits? The Act is saying under 115 BBF, we will allow you a concessional tax rate of 10%. But by including it under book profit, we are subjecting it to the tax rate of 15%. So that would go against the concession which has been given to such royalties. So that is the reason why we will reduce the royalties taxable under section 115 BBF at the rate of 10% on the patents registered and developed in India. And we'll add back the expenditure on these royalties. Are we clear? Yes? Any questions so far? Any doubt? Okay. Next particular point. Last point before we move on to the next part of it is with respect to the income accruing to a foreign company. So income which is accruing to a foreign company from the capital gain arising on transaction in securities. Capital gain only on transaction in securities, interest, dividend, royalties, FTS. These are taxable at a concessional rate, again under 115A, or sometimes at the rate which is given in the tax treaty, whichever is beneficial, which may be lesser than 15%. So in case of, for example, foreign companies, dividend is taxable at the rate of 20% as per 115A. Right? So in that case, if the dividend is now subjected to MAT, then we were going to tax at a lesser rate of 15%. Sometimes the dividend under the tax treaty may be taxable at, let's say, 5%. Now in that case, I'm subjecting it to MAT at a rate of 15%, which will be higher. So therefore, in that situation, the Act says that from the MAT, from the book profit calculation, these incomes will be excluded. Are we clear? So the adjustment will be made in respect of the dividend receipt and the expenditure relating thereto for the purpose of calculating the book profit. If the tax is less than the 15% on account of the concessional tax rate provided in the DTL. Are we clear? So just write down. Income of the foreign company. What income? The capital gain on transaction in securities, royalties, FTS, dividend, interest, taxable under section 115A. Right? If these incomes are subjected to tax at the rate lesser than 15%, either under the Act or the DTL, then less the income, add the expenditure in relation to the income. Clear? Are we clear? Yes or no? last point. Losses. Brought forward losses and the unabsorbed depreciation. Now, see, you would have studied the set off and carry forward of losses, right? Under section 72, you do the set off and carry forward of losses. Now, in respect of this MAT calculation, it says you can set off the book losses, but lower off the unabsorbed depreciation or the business loss. Not as per the income tax, as per the books of account. However, in case of a company, which is applied for the insolvency, in that particular case, so any company which is applied under the insolvency and bankruptcy code, in that case, the aggregate of the unabsorbed depreciation and business loss shall be allowed. This is in case of company which has applied under the IBC. Okay. For other companies, it is lower off the unabsorbed depreciation or the business loss. In case any of the figure is nil, you will not be allowed any deduction. But for the companies which have applied for the IBC, it will be the aggregate of the UAD or the business loss. Are we clear, students, with respect to the book profit calculation? Yes or no? Any questions so far? Yes? Yes or no? Fine. Okay. So after the break, we'll do one question from the module wherein you are required to answer me, and then we'll proceed further. So let's take a break of 10 minutes and then we get back. Okay. Let's give a break. Ashok ji. Ashok ji. Just share the screen. With respect to your module, so that we can solve a question around that. Okay. I hope you are able to see the screen. Okay. So, question is, a domestic company ABC Limited furnishes the following particulars in respect of assessment year 25-26 and seeks your opinion on the application of section 115 JB. You are also required to compute the total income and the tax payable. So there is profit given 215 lakhs, credit is given for dividend income from Indian company, excess realized on sale of land held as investment, debit are given depreciation on SLM, provision for loss of subsidiary, depreciation allowable as per Income Tax Act, short-term capital gains on sale of land mentioned above, and losses brought forward as per books of account and as per Income Tax Act. Then you have business loss and the unabsorbed depreciation. So here it is saying that ignore the provisions of section 115 BAA because in that case the match will not apply and you are required to compute the total income. Okay. So how will you start with it? Yes, students, step by step, tell me first what you will do.
We will write first of all profit as per company's profit and loss.
Okay, but first you will start with MAT or first you will start with the normal provisions?
First we will start with normal provision.
Okay. So normal provision may, the first step we are saying we'll start with the 215 lakh profit and loss account. Then what about the dividend income from the Indian company? What will happen to that? What about the dividend income from Indian company?
It will not include.
So what will be the effect of that?
We will reduce. We will reduce it from profit and loss.
You will reduce it from profit and loss, and then what will be the second effect of that? Yes, students, please faster.
It will go in the income from other sources.
Yes, correct. It will go under income from other sources. You will reduce it from the business income because this is not business income, and you will consider this as the income under the head income from other sources. Correct. Excess realized on sale of land held as investment. What will be the effect of that? Yes. Please, students, be faster. It's not at all a difficult question.
Ma'am, excess realization.
Sorry. Yes, Mitali.
Yeah, ma'am, we less it from the profit
Yes.
and
You
it will our capital gain.
correct. So we'll reduce this 30 lakh, which is appearing over here from the PGBP, and we'll consider this short-term capital gain of 40 lakh, which is as per the Income Tax Act. Okay. Next is depreciation on the SLM basis. This is very simple. We'll add back this 100 and we will reduce the depreciation allowable, which is 150. What about provision for loss of subsidiary company?
We add back it.
Yeah, you will add back. That will not be allowed under the normal tax provision also, right? Then what about the set off of the business loss and the unabsorbed depreciation? So first we will see what is our business income coming to. So if you see here, they have given the net profit as per the P&L account 215. They have added back the depreciation, provision for loss of subsidiary, which is 160. And from that, the dividend and the excess on the sale of land is considered. So that gives us, and the depreciation as per the income tax act. That gives us the business income of 175, right? Now, out of 175, I have here business loss and the unabsorbed depreciation. So what will be the impact?
We less them set off.
Yes, we'll set off the business loss and the unabsorbed depreciation both, because this is coming to how much?
110.
110, right? So 110, we can reduce it from 175. So that we'll do it. We'll add the capital gain dividend. That gives us the income of 125, right? Now on this income, we will first consider what is the tax. So what tax rate will you apply over here? What is the tax rate which we will apply?
Normal tax we will apply over here.
Normal as in what tax rate?
25%.
Correct. 25% is what we will apply over here. Sorry, not 25%. Whether the turnover is given over here, whether the turnover of 22-23 is less than 400 crore, how will you apply 25%? 25% is for the turnover less than 400 crore. Here no information is given. So can we apply 25%? See, one way you can do it is, you can assume that the turnover is less than 400 crores in absence of any information, and you can apply the 25%, right? Because here, if you look at it in the question, they have not given any information with respect to the turnover. Okay, yeah, they have given. Sorry, my mistake. It was given that for 22-23, it is 390 crores. So, of course, yes, we will apply 25%, right? So, here the turnover information is given. If the turnover information is not given, you can make an assumption, or you can directly apply the 30% rate. The better way is to apply directly 30% rate. Here, since the turnover is less than 400 crores, then your problem gets sorted. It will be 25%. And what will be your surcharge? What will be my surcharge over here? My income is 125. What will be my surcharge?
%12.
How 12%? This is 125 lakhs, not crores.
Okay, ma'am. Sorry.
It will be 7%.
7%.
Yeah. So 7% surcharge, and health and education cess of 4%, which makes your total tax as 34,77,500. Now, coming to the book profit calculation, again, we'll start with 2.5 lakhs. What about the dividend income from Indian companies under the MAT calculation? Yes, under MAT, what you will do for the dividend? Yes, please.
Ma'am, repeat the question.
What will happen to the dividend under MAT calculation?
Less than?
We will add back.
No. There is a provision to add back. See, students, if I take you back to our slide where we had discussed about this. If you look at here, did I tell you that dividend has to be added back? Where is it written? And I told you, you have to make only the adjustments which are specified under the 115JB. You don't have to go beyond. Dividend paid or proposed by the company, that is to be added back. If you have reduced from your profit and loss account, the company which is declaring that dividend, so when you declare the dividend, you pass the entry P&L to dividend, isn't it? So that dividend has to be added back, not the dividend received. This is a dividend received, students. This is a dividend income and not dividend paid. Dividend paid agar rehta, so you will reduce it. This is a dividend income. So we will not reduce it, students. Clear? What about the excess realized on sale of land? Yes. Excess realized on sale of land. Yes, please, fast.
No treatment, ma'am.
No treatment, yes, correct. Then next one is depreciation on the straight line method basis.
We add back and less according to income tax.
No, I just now said, if you see here for the depreciation, I said you will add back as per books of accounts. But you will reduce also the depreciation as per the books of accounts only and not as per Income Tax Act, students. So this effect is to be given only to add back the depreciation in case it exists on the revalued asset. So if you see here, the calculation, depreciation as per books of accounts, 100. Less depreciation as per books of account, 100. So this is a presentation that you have to do. In case there is depreciation on revalued asset, you will have to first include it, and then when you're doing the deduction, you have to exclude it. But it has to be the same depreciation as per books of accounts when you reduce it. You don't have to reduce as per the Income Tax Act. Are we clear?
Yes, sir.
Provision for loss of subsidiary company.
No treatment.
No, it has to be added.
Add back.
Yeah, it is told here, provision for loss of subsidiary company, add back. So see, which provisions are to be added back under the MAT? Provision for loss of subsidiary company, provision for income tax, provision for unascertained liability, and provision for diminution in the value of asset. Under the MAT, only these 4 provisions are to be added. Okay? Yes or no? Fast. Okay?
No, but we already do it in calculating income tax, right? Earlier also.
Yeah, so then now you're computing the book profit. So that is a separate computation, and then you will compare कि tax किस में ज़्यादा आ रहा है, MAT में ज़्यादा आ रहा है कि income tax में ज़्यादा आ रहा है.
Okay.
Yeah. Okay. What about the losses? Sorry, short-term capital gain on sale of land.
Less than.
No, in the MAT you will not give any effect. Under the MAT, see the first year excess realized, which is appearing over here. I have not reduced that also. I have considered that in the book profit. I have not given any effect of this. This is the loss which is as per the books of accounts, or this is a gain which is as per the books of accounts. So here, as per the normal provisions, I will not consider. I have considered already this in my books of accounts. I have not given any adjustment under MAT. So this will be ignored. Are we clear? Then losses brought forward as per books of accounts and as per Income Tax Act.
Less than?
Yeah, but how much amount? What is the amount?
Amount as per books of accounts?
Yeah. So as per the books and as per income tax is same only. But here, do we reduce both or do we have to reduce only one of these?
Both of them?
Yes. In case if it's a company which has gone for IBC, in that case, if it is given in the question that this company has gone for IBC, in that case, you will reduce the both. But in any other company's case, here it is not mentioned that whether this company has gone for IBC or not. So therefore, it becomes any other company. In that case, you will reduce any one of them which is lower. So 50 or 60 lakhs, whichever is lower. Now 50 lakhs is less, so I will only reduce here 50 lakhs. So as per for the book profit calculation, if you see, I have taken the net profit, I have added the provision for loss of subsidiary depreciation, I have reduced the same depreciation and the business loss because it is less than unabsorbed depreciation. In case in exam, it might be a question ki business loss including unabsorbed depreciation is 50 lakh and unabsorbed depreciation is, let's say, 10 lakh. So what you will do is you will reduce from the business loss the unabsorbed depreciation and balance only you will consider and compare it with the unabsorbed depreciation. So whatever will be less will be allowed. Are we clear? Now on this 225 lakh, I will apply the MAT. What is the MAT rate? What is the rate of MAT? Yes, faster. What is the rate of MAT?
15%?
Yes, it is 15% under the MAT. So therefore, you will apply on 225, 15. Here, whether surcharge is applicable, answer is yes, because the income is exceeding 1 CR. So you will add a surcharge of 7% and then cess of 4%. So under MAT also, you have to add surcharge and cess. Now my MAT comes to 3755. My normal tax was coming to 3477. So obviously, my normal tax is lesser than 15% of book profits. So book profits will be deemed to be the total income and we will pay MAT of 3755,700. Yes, are we clear about this? Yes or no?
Yes, ma'am.
Yes. Shall we do one more question here?
Yes, ma'am.
Okay. So see, here what will happen is, students, the moment you will pay under MAT, so the difference between the MAT and the normal tax, which is around, 1 lakh, which is coming over here, this amount will be called as MAT credit. And in the next year, when you pay as per normal provisions, you will get the reduction of the MAT credit. So the MAT credit is nothing but the difference between the amount which is payable as per the MAT and the normal tax which is there. So the excess of the tax which is paid as per MAT over and above the normal tax is considered as MAT credit, which is allowed to you to be set off in the future year when you are paying the tax as per the normal provision. Are we getting it? So this tax credit can be carried forward for a period of 15 assessment years. So, if you can write over here, MAT credit, which is the difference between the MAT liability minus the normal tax. Allowed be carry forward for next 15 assessment years and set off against the normal tax. Okay, so you can carry forward and set off the against the tax payable in any assessment year in which you are paying the tax as per the normal provision. For example, if you look at in your module, they have given the example. Let's say in year 1, we have MAT of 4,50,000. We have tax as per regular provision 395. So of course, the MAT is higher, so we'll pay under MAT. So the difference between the two of 55,000 is my MAT claim. Again, in the next year, I'm paying as per MAT because MAT is 470. Tax as per normal provision is 4,10,000. So the difference between the two is 60,000. So I will again get a MAT credit in year 2 also. So 55,000 plus 60,000 will be my MAT credit, which will be accumulated in my account. In the year 3, my MAT is 3,80,000. Tax as per normal provision is 4 lakh. So I will pay the tax as per normal provisions because that is higher. So now when I will pay tax as per normal provision, I will get the credit of 20,000, which is the difference between the two. So this 20,000 will be reduced as MAT credit and only the actual tax payable will be 3,80,000. Balance 95,000 out of 1,15,000, 20,000 is utilized. So balance 95,000 will be carried forward for the next assessment years for the 15 years which are available from 22-23 and 23-24. Are we getting that? So this you have to be careful. Are we clear or not? Yes or no about this? Okay. Perfect. Now let's solve one more question on this particular part. Okay. Sona Limited, a resident company, earned a profit of rupees 15 lakhs after debit or credit of following items to the statement of P&L account. So I'm not reading it again. We'll just see what we have to do. Here they have just told us to compute the MAT under 115 JB, assuming Sona is not required to comply with Indian accounting standards and we have to ignore the provisions of 115 BAA. So here we have to just compute the MAT. We don't have to compute the normal tax. Okay, so tell me, we'll start with the net profit of 15 lakh. What about provision for loss of subsidiary?
Add back.
Perfect. Provision for doubtful debts.
Add back.
Where is it written?
Uncertain. Provision for uncertain.
Yes, absolutely. So it is not specifically written, but provision for doubtful debts is a doubtful. It is an uncertain liability. It's not a certain liability. Right? So therefore, we will add back this 75,000 also. Also, secondly, what we can also say is that this is a provision for diminution in the value of asset. Debtors are my asset. So this is a provision for diminution in the value of asset. So even that is not allowed. So even one may say that this is an uncertain liability because we have calculated based on reasonable evidence that this amount will not be collected. So then that would have been, of course, bad debts. But even if one may say that, okay, we have booked as a provision. But even in that case, provision for doubtful debts is not allowed because there is a provision which says that provision for diminution in the value of asset will be not allowed. So debtors are my asset and this provision is reducing the value of my asset. So this will not be allowed. What about provision for income tax?
Again, add back.
Again, add back. Perfect. Provision for gratuity based on actuarial valuation.
Ma'am, add back.
Add back.
Yeah, ma'am. Actual valuation is also a type of exemption here with expectation, not actual amount.
No. So see, I just now said it in the provision for a certain liability, provision for gratuity. If it is based on actuarial valuation, now actuaries are capable of calculating in a very reasonable manner. Okay, so it may not be the actual liability. That's why it's a provision. But it is quantified amount. So provision for a certain liability means what? That there is a reasonable obligation that will arise out of a past event, which is satisfied. Secondly, there is a reasonable certainty that this payout has to be made, which is also satisfied in this case. And the amount can be estimated on a reasonable basis. That is also satisfied. So this will be regarded as the ascertained liability and not unascertained liability. So if you see here, I have clearly written provision for gratuity, even if it is disallowed under 40A7 under normal provision. Under the MAT, this will be allowed. Under MAT, this will be specifically allowed. This will not be considered as the unascertain liability if it is based on the actuarial valuation, and this has also been upheld by the Bombay High Court. Are we clear?
Yes, ma'am.
Yes. Okay. Next one is, students, depreciation. What will be the effect?
Ma'am, no effect.
See, for the presentation purpose, we will add it. As I
Then
said
less.
in the earlier example also, what we have discussed, if you see, we have added and we have reduced. So don't give any effect. You will get lesser marks if you say no effect. You have to add back and reduce the same amount. So for the presentation purpose, you will still follow by adding back and then reducing the same amount. Are we clear?
Yes, ma'am.
Okay. Interest to the financial institution unpaid before the filing of return. Yes, students, there are so many students present, but only one student is answering. Please answer. Yes, others also please participate. Otherwise, you will not understand and you will not learn. Please make mistakes. That you can make mistake here, but not in exam.
Ma'am, no effect.
No effect. Yes. What others think? Bhaskar, no effect. Good. So there will not be any effect because this is not a specified adjustment. What if you would have to compute under normal tax provision? There, what would have been effect under normal tax provision? If I would have told you to compute as per normal tax provision also, what would have been the effect under normal tax provision for this item? Yes, please, faster students, please answer. You can put it in chat boxes as well.
Ma'am, no effect there also.
No, that's not right answer. Anybody else would like to attempt? Bhaskar also saying no effect. No. Anybody remembers what is section 43A? What was section 43A of Income Tax Act? Yes? Do you remember, guys? Yes, students, faster. 43A. Yes, Bhaskar, correct. payment before filing the return of income. Under 43A, there are certain expenditures which are only allowed if you make the payment before the due date of filing of return of income. And interest paid to financial institution was one of them. Isn't it? Interest paid to financial institution was one of them. So under normal tax provision, what would have been the effect? Yes?
We add back.
Yes. It would have been disallowed because this is unpaid before the filing of return of income.
Excuse me, ma'am.
Yes?
Ma'am, your screen is not visible to me.
1 second. Let me share the screen again. Is it visible now?
No, yes, ma'am. Now visible.
Okay. Yes. So interest to financial institution under normal tax provision, you will add back as per section 43A of the Income Tax Act. Right? Are we clear about this under normal tax?
Yes, ma'am.
Yes,
Okay.
ma'am.
Penalty for infraction of law. What will be the impact? Yes, Bhaskar, you are saying add back. What about other students? Do you think add back or not?
No, ma'am. No effect.
Not add.
No effect? Yes, the right answer is there would not be any effect because there is no impact of that in the profit and loss account because it's not a specified adjustment. What about under the normal tax provision?
We add back.
Yes, we add back under section 37 of the Act. Fine? Okay. Profit from unit established in the SEZ, 5 lakh. Yes?
No effect.
मैम यहाँ पे तो 10AA का exemption मिलता है ना?
Yes, correct. So, if you see here, I had told you that in case the income is exempt under section 10, 11 or 12, that income will be reduced. On that, MAT is not applicable. Because kya hoga? Your objective to give that incentive by exempting the income will be defeated. Right? So, I have exempt a particular income because I want to incentivize that sector. I want to incentivize the SEZ. I want to promote the SEZ. अगर मैं उस पे MAT लगाऊंगी, if I levy the MAT on that income, then my objective is defeated. So I will reduce that income from my book profits. So profit from unit established in SEZ is subject to the exemption under 10AA. So this income will be exempt from the MAT. So we will reduce it. Share in the income of an AOP as a member.
Ma'am, less from the profit.
Yes, we will reduce it. In the information also they have said the AOP of which the company is a member has paid the tax at the maximum marginal rate. So if the AOP is already paid the tax, the amount will not be taxable in the hands of the member and therefore this share in the income of member will be considered to be exempt and reduced from the book profit. Income from units of UTI. Income from units of UTI.
Reduce, ma'am.
No. There's no particular provision for that. It's not even an exempt income. So we will give no effect to this. Long-term capital gain on sale of building.
No effect.
No effect. Perfect. Let's go to other information. Depreciation includes 1.5 lakhs on account of revaluation of fixed assets.
We will add back.
Yeah, but see, we'll not add back technically. So what is the first effect that we have given? We have added back this depreciation of 3,60,000, right?
Yes,
Now,
ma'am.
what we would have ideally reduced is again 3,60,000, right? That's
Yes,
how I told you the presentation. You don't have to reduce the depreciation as per income tax. You have to reduce the depreciation as per books of accounts, right, students? So here by reducing 3,60,000, उसमें से out of that I will reduce 1,50,000. So I'll tell you how. See, 3,60,000 is added back over here in the answer, right? Out of this 3,60,000, while reducing, when I'm doing less, I'm allowing the depreciation, I will allow 3,60,000 minus 1,50,000, only 2,10,000. So essentially what I'm doing is I'm adding back 1,50,000. But the presentation that you have to make in the exam is like this. Add back 3,60,000, reduce 360 minus 150 on account of revaluation.
yes, ma'am.
Presentation purposes, students, remember this very thoroughly. You have to add back the actual amount. You have to reduce the amount excluding the depreciation on revaluation of asset. Are we clear? Yes?
Yes, ma'am.
All of you in the class, whosoever is present, are we clear? If you have any questions, please stop me here only. But I would request, please participate so that you don't make mistakes in the examination. Are we clear? Okay. Then they are saying brought forward loss as per books of account. Okay, depreciation as per income tax rules, irrelevant, right? As I said, depreciation as per income tax rules under math is to be ignored. Brought forward loss as per books of account of the company is 10 lakh, which includes the unabsorbed depreciation of 4 lakhs. Just now how I was talking about. So here, what you will reduce?
Ma'am, whichever is less, like 6 lakh and 4 lakh. So it's less is unabsorbed depreciation 4 lakh.
Yeah, correct. So out of, you will compare not 10 and 4. See students, be very attentive over here. You will not compare 10 and 4. 10 includes 4. You will compare 6 and 4. This is not a company which has gone for IBC. Right? So you will compare 6 and 4 and you will reduce 4 as the unabsorbed depreciation. If unabsorbed depreciation is 0, then you will not get any loss allowance. Remember that. Are we clear? Yes or no? So we'll reduce 4 lakh. Provision for income tax includes 45,000 of interest payable on income tax. Interest payable on income tax is also disallowed under MAT, right? So any which ways, we have already given the effect for that. So if you see, they have come to the 14 lakh as the book profit. On that, again, 15% will be MAT. Here, there is no surcharge because my income is, my book profit or my total income is 14 lakh and not more than 1 crore. So surcharge will not be applicable and only the cess will be applicable. Do not forget to add surcharge or cess wherever surcharge is applicable. Be double sure in the question if the surcharge is becoming applicable or not. Yes, students, is the MAT provision very clear to you? Is there any question? Is there any doubt? Yes, anybody has not understood any point? Yes? Clear to everybody? I need answers in the group. Yes or no? Yes? Okay, perfect. So now let's move to the second part of the matter. Math for IndAS compliant companies. So students, there are certain companies, right, to which IndAS becomes applicable, isn't it? There are certain companies to which the IndAS becomes applicable. Now, when the IndAS become applicable, the book profits are little different from how it is for a normal company, isn't it? So in that case, there is a different mechanism which is given with respect to the IndAS compliant companies. That how do we have to calculate the book profit in case of the companies which are complying with the IndAS, right? So in that particular case, in case of a company whose financial statements are in compliance with the Indian accounting standards, apart from the normal adjustments that are given under the 115 JB, so those normal adjustments will still be made. It's not that you will not make this normal adjustment. But apart from the normal adjustment, there are certain additional adjustments which are to be made to the book profit. So you can write here additional adjustments to the book profit or IndAS compliant companies. The first adjustment is add amount credited to the other comprehensive income, OCI, in the P&L under the head items that will not be reclassified to P&L. Less amounts debited to OCI in the P&L under the head the amounts that will not reclassify to the P&L. So what is the OCI? You know better than me. What is OCI?
Other comprehensive income.
Sorry?
Other comprehensive income statement.
Yeah, but what is that? Which are the items which are included in OCI? Yes?
Ma'am, any unrealized gains?
Yes. Any unrealized gains? Revaluation profits, Aaron? Yes, right. So basically, OCI which is there, it is other comprehensive income. These are the revenues, expenses, gains and losses that are not included in my net income. This is other than my P&L account. It is an extension of the P&L account which gives the idea to the shareholders that what are the other unrealized kind of incomes, unrealized kind of losses, foreign currency translation adjustments. So OCI has certain items of income which may not yet have been realized. And therefore, these are not the part of the P&L. So profit and loss account income includes all the items of income and expense. Whereas the OCI which is there, here what is not recognized in the P&L account is recognized by way of the OCI, meaning this has still some implication to the income. Are we clear? So it's a below the income statement item. Because let's say, for example, we are talking about the investment, gain or loss on investment. The changes in the value of investment till that point in time, whatever gain or loss is happening because of the change in the value of investment as on the closing date will be recognized in OCI. When the investment is actually sold, it's disposed of, it is transferred. The gain or loss, which is actual gain or loss which is arising, that will be recognized in P&L. Are we getting this particular thing? So there are different items which are considered in the OCI. So what the 115 JB is telling us, it is saying that in case you are going as per the IndAS, you increase to the book profits all the amounts which are credited to the OCI and reduce all the amounts which are debited to OCI, which are under the head items that will not be reclassified to the profit and loss account. Are we getting that? So those items which are under that head, those you will have to add back if it is on the credit and reduce if it is on the debit. So that this is done so that people do not manipulate with the books of accounts by not showing in the P&L and showing it in the OCI. That is the reason why they are giving this specific set of adjustment. See, what the management will do in the books of accounts, they will try to put every item in OCI and avoid the MAT, because MAT is on book profit. Book profit OCI में आता ही नहीं है. Book profit is as per P&L, as per your schedule 3. So what you will try to do in order to reduce your MAT liability, you will classify those items into the OCI. So what they are saying is that certain items that are not going to be reclassified to P&L, which are appearing in OCI, add those if it is on credit side, reduce those if it is on debit side. Are we clear? Is this particular point clear to everyone or not? Yes or no? Fine. Now in that, they say that no adjustment will be made. No adjustment will be made with respect to, so no adjustment, that means you will ignore few items which are credited or debited to OCI. That will not be reclassified to P&L. We are talking about the amounts that are not reclassified to P&L. We are not going into the other amounts that will be reclassified. We are not looking at that. We are looking at items which will not be reclassified. Revaluation surplus. So any which ways, if you see in the book profit, we ignore the revaluation. We ignore the provision to revaluation. We ignore the depreciation on revaluation. So even in OCI, we will not consider the revaluation surplus for assets. So this item will be ignored. Second is gain or loss on, gain or loss from investments, gain or loss from investments in equity instruments designated at fair value. So basically, any notional gain or loss which is arising on account of valuation of investment, you can write here notional gain or loss. So that has to be equal. When actually the investment will be disposed of or transferred, in that year you will increase or decrease the book profit by the actual loss or actual gain. Are we clear? So, in the year when the investment is actually transferred, actual gain or loss on transfer would be added or stripped. Are we clear about this? Yes or no? Yes, any questions? Mitali, you have not understood anything? Any doubt you have? Yes? So in the OCI, what is happening is that items that will permanently be recorded in reserves and will never be reclassified to the P&L will be added if they are credited to OCI, will be reduced if they are debited to OCI. Because see, these items are not going to be reclassified to P&L. The items which will be reclassified to P&L, we know that they will sooner or later come to P&L. We are not concerned with that. For the book profit calculation, the government was worried that these may be just recorded in OCI and will go to the reserves. This will never touch the P&L, and by that means the people will start avoiding the MAT liability. So in order to avoid that, they said that items which are credited or debited to the OCI that will permanently never be going to the P&L, that will never be reclassified to P&L, will be added or reduced. What could be those items which are there? You have done your FR. What are the items which are never reclassified to P&L? Changes in revaluation, surplus of plant, property or equipment. So revaluation on plant, property or equipment, intangible assets. Right? These are never going to the P&L. These will be booked in P&L only when there is actual gain or loss realized. Similarly, gain and losses from the investment in equity instrument. Again, that's a notional loss. So that we will reduce. That we will ignore. That we will not consider in the OCI. Right? Because that is a specific exclusion which is given. So actual gain or loss, when it is realized, we'll add back that or we'll reduce that. So basically, what other items which will be there in OCI? Remeasurement of defined benefit plans. Right? Or any other item. So that will be credited or debited as per the, if it is credited or debited, will be added or reduced in the book profit. Are we clear? Any questions with respect to this? This is a very different topic in the MAT. Do you have any questions before we move forward? Yes. If anybody has not understood anything, please let me know. I can repeat it.
Ma'am, second point in this gain and loss from investment.
Yeah. So as I said, this is a notional gain or loss. See, you value your investments as on 31st March and then you realize the gain or loss, which is a notional gain or loss. So that we will ignore. We will not add back or we will not reduce in the adjustment that we have to make for OCI. We will record the actual gain or loss only at the time when the investment is disposed. So two items from the OCI are to be ignored. One, as I said, which is with respect to the revaluation surplus. Secondly, the notional gain or losses. Any other items which are there apart from that, we will add back or we will reduce. Are we clear?
Yes, ma'am.
Okay. Next one is, so one is, first one was this, amounts reflecting in OCI. The second one is on the demerger. So during the demerger, right, the IndAS 10 provides that any distribution of non-cash assets during the demerger to the shareholders of the demerged company, right, shall be accounted at the fair value. So the difference between the book value and the fair value is credited or debited to the P&L account. Are we getting that? So IndAS 10 provides that the distribution of non-cash assets when the demerger happened. You remember we had done the demerger in the capital gain class. When the demerger happened, the resulting company has to give the assets to the, let's say, shareholders of the resulting company as a compensation sometimes. Right? They may give the shares plus they may give some cash or non-cash contribution. So whatever the distribution of non-cash assets to the shareholder is given, they have to account it not at the book value but at the fair value of those assets. So the difference between the book value and the fair value is recorded in the statement of the P&L. And the reserves will also be debited to record as a distribution as the deemed dividend to the shareholders. Right? When you give any assets to the shareholder, it is a deemed dividend. Right? So this difference which is arising on the demerger, this has to be excluded from the book profit. So what they are saying is you have to add the amounts debited to the P&L on distribution of non-cash assets to the shareholder in a demerger, which is essentially nothing but the difference in the fair value minus the book value. Right? Because you have to record the assets at the fair value. Less any amount credited to P&L on the distribution of non-cash assets. So any debit or credit which is made to the P&L because you have recorded the assets at the fair value. So the difference that you have recorded, the gain or loss, again, it's a notional gain or loss. So that we have to ignore. Are we clear? Yes or no? Similarly, when the resulting company takes over the assets and liabilities of the undertaking which is demerged, again, they will record the assets and the liability at fair value. So again, at that point in time, there will be a notional gain or loss. So that also has to be ignored for the purpose of computing the book profit of the resulting company. This is in the case of the demerger. This effect is in the books of the shareholder. Right? This effect is in the books of shareholder and not in the hands of the demerged or resulting company. Fine. In the hands of the resulting company also, it will be the same. Next one. Next one is about the differences which are arising on the transitional amount. So you can write down. See, let's say for example, you have become the IndAS compliant company for the first time. Till now, IndAS was not applicable. So in the first year, when you are applying the IndAS, there may be certain transitional differences. So in the first year of adoption of IndAS, the company would prepare the IndAS financial statement for that year. But if you know, under the Companies Act, when you prepare the financial statement, you have to prepare a comparative financial statement for 2 years. For the last year and for this year, that is mandatory. Now, the last year, I would have prepared as per normal provisions. In this year, I am going for IndAS. So, how will I prepare a comparative financial? So, to prepare a comparative financial statement, I will have to make certain adjustments to make the last year also compliant with IndAS. So, a company, as per IndAS 101, a company would make all the IndAS adjustments on the opening date of the comparative financial year. Right? And they will have to make a reconciliation between the AS and the IndAS, what differences are coming, both on the opening and the closing date. So, with respect to that, there will be certain amounts which will be arising in your profit and loss account. So, to compute the book profits in the first year of adoption, the adjustments will be made. So, let's say, for example, there's a company, it is becoming the IndAS compliant from this 24-25 financial year. So, last year it was doing as per AS. So, it will have to restate the financial statements for the last year also to make a comparative financial statement for financial year 24-25. So, in this case, for a period of 5 years from the date of adoption, there will be an adjustment made for the transition amount. Are we clear? Is this clear up till now?
Yes, ma'am.
Yes, anybody, any doubt? Yes or no? Any questions? Okay, so the transition amount which is going to be there, the transition amount which is going to be there is going to be the aggregate of the amounts which are appearing in the other equity on the convergence date when you are complying with the IndAS. So, your transition amount is equal to the amounts appearing in other equity, excluding capital reserve and the security premium. So basically, as I said, when I will convert the last year into the IndAS also, so I will record the differences which are coming because of AS and the IndAS application in the other equity. So that amount is my transition amount. So amount adjusted in other equity, which is excluding the capital reserve and surplus. That amount will be my transition amount on account of transition from AS the IndAS. However, the following amounts will be excluded. right? Certain amounts will be excluded. But what is my transition amount in short? It is the adjustments which are arising on account of my transition from AS to IndAS, because I am preparing a comparative financial statement. Last year I had done as per AS. Now I have to account as per IndAS to prepare the comparative financial statement. So any adjustments which are arising on account of transition is required to be recorded in the other equity at the date of transition. Are we getting that? So the book profit of the year of conversions is increased with the transition amounts which are recorded in the other equity for a period of 5 years, which is including the year from when the conversions took place. Now, other equity will exclude capital reserve and security premium. Yes or no? Clear? So, from this transition amount, what I will exclude? Number one, I will exclude the amounts which are adjusted in the OCI amounts which are appearing in OCI under the head amounts which will be reclassified to P&L. See, I'm not saying amounts which will not be reclassified to P&L. I'm talking about the amounts which will be reclassified to P&L. So amounts which will be subsequently reclassified to P&L shall be included in the book profits in the year in which they will be reclassified to the P&L. And therefore, I will not consider these amounts. I was not even considering these amounts in the adjustments that we have made already. Isn't it? There also what amounts that we were considering? Amounts which will not be reclassified to P&L and are appearing in OCI. So in the transition amount also, I will not consider the amounts which will be reclassified to P&L because I will consider them in the year when they will finally be reclassified to P&L. So these amounts are to be excluded from the transition amount. Number one. Number two, revaluation surplus. Revaluation surplus for assets. See, in the OCI adjustment also, I had excluded revaluation surplus for asset because this is nothing but a notional gain. So when I will actually dispose of my plant, property, equipment or intangibles, I will realize the gain at that time and I will include it in the book profit. I will not include the revaluation which is there. In the OCI also I have ignored that. Here also I will ignore this. Next is notional gain or loss on the investments designated at fair value. So as I said, any notional gain or losses which are there on investments have to be ignored even in OCI. In transition amount also I will ignore it because I will book this when there will be the actual gain or loss which will be arising. Next is adjustments relating to the plant, property and equipment. Adjustments, or you can again say notional gain or loss on plant, property, equipment and intangible assets designated at fair value. So again, this is the same thing that I will not consider any notional gain or losses which are there. I will book this when there is actual gain or loss. So the entity may classify may, and on the opening date, consider the plant, property and equipment at the fair value. Because that's what IndAS 101 says. So what the MAT provision says that in case of revaluation of assets, in case of change in the value of asset, any impact on account of revaluation has to be ignored. As I said, even the depreciation on revaluation has to be ignored. So we have to record the actual gain or loss on the realization of the investments. So any revaluation has to be extremely good. Are we clear? Next is adjustment relating to the investment in subsidiary, joint venture and associates recorded at fair value. So again, if you see, an entity will again record the investments in subsidiary, joint ventures at the fair value. So again, there is a notional gain or loss which is arising. In such cases, the gain or loss again has to be booked at the time of realization of such investment and not earlier. So therefore, even that will be ignored. Are we clear? So you can write adjustment or again notional gain or loss. And the last one is differences which are arising relating to the translation difference of foreign operation. So basically, the entity may select to cumulate the translation differences for all the foreign operations, right? The entity has a choice whereby the translation differences for all the foreign operations, you have to record the foreign operations income, expenditure, you have to consolidate that, and you will account for the foreign exchange gain or loss, right? So again, if there is a notional gain or loss which is there, that is to be ignored. Only when there is an actual gain or loss which is arising, only that has to be accounted. Are we clear? Yes or no? Yes. Is this clear? So these adjustments have to be made in respect of the IndAS compliant company. Are we clear? Any questions so far?
Ma'am, these amounts, otherwise excluding amounts, we will add back now.
Yes.
Okay. Yes.
So what you will do is, with respect to this transition item, this 1/5 of transition item shall be allowed for 5 years, including the year of convergence. So every year we will allow the 1/5 one. Yes. Are we clear? Any questions? Any doubt? Yes, students, is this clear? Beyond this, you will not make any adjustment. Beyond this, there will not be any adjustment which is required to be made. So the only adjustments which are given over here, only these adjustments, students, you will have to carry out. Are we clear? So when a company will transition, it will have to prepare the books of accounts, and in that particular case, the transition amount which is there, the 1/5 of that will be allowed. clear? Any doubt if you have? Yes. From the transition amount, you will exclude the capital reserves or the security premium which are there. Those are not to be considered.
Excuse me, ma'am.
Yes.
Actually, any आपने जो 1/5 लिखा कि ये अलाउड है, इसका मतलब ये हमें ऐड करना है या फिर थोड़ा मैं कंफ्यूज हो रही हूँ इसमें.
Yes. See, we have to add this amount, the transition amount which is going to come, the 1/5 of that transition amount. You will consider this in the book profit calculation. You will have to add this.
1/5.
Yes, the 1/5.
Yes, ma'am. Now clear.
Okay. We are going to solve a question on this. It was a past exam question. We are going to solve that particular question.
Okay.
Yes. Any other questions do you have? Yes, students.
Now clear.
Yes. So any notional losses on plant, property, equipment are to be ignored. You have to account for the actual gain or losses. So the book profit of the previous year in which the actually plant property is transferred shall be increased or decreased in that particular year. Right? So let's say, for example, in the year 1, when I'm complying with the IndAS, my actual book value of the asset may be, let's say, rupees 100. Now I have to account it at the fair value as per IndAS 101. So I'm recording it at now 1000. So the difference between the IndAS value, which is the fair value, minus the actual book value, 900 rupees, will be my accounted in my book profit, or not in the book profit, in the OCI. So in the OCI, I will ignore this amount. This amount will not be credited to P&L. This amount will not be reclassified to P&L. So this 900, which is the difference, I will have to ignore this. Even the depreciation on revaluation, that will also be ignored. Are we getting that point? So when I will actually sell this asset, let's say I'm selling this asset for rupees 900, actually. So in the books of account, what you may be doing is you may be calculating a different figure of the profit and loss account. Right? But the actual amount which is there, 900 minus the amount which is the book value, that will be considered for the MAT calculation. So an example it is given in your module, I can show you. See. This is the amount of the plant, property and equipment, 100. The fair value is 1000. So the difference is 900, which will be reflected in the OCI, that will not be reclassified to P&L. So the depreciation is only 10 is going to be allowed. This 100 rupees, the depreciation on this, the 90 rupees which is there is going to be ignored. I told you depreciation on revaluation of asset is not to be considered. So first I will add back 100. What I will do is I will reduce only 90. Sorry, I will reduce only 10. I will add back, in fact, 90. Because this is a depreciation on revaluation. Are we getting this point? So depreciation on revaluation is also not allowed. Then again, let's say my WDV becomes this. I will again have a depreciation in 23-24. Again, I will add back first 90 and reduce only 9. Because I have to ignore the depreciation on revaluation. This will give me WDV as on 1st April 24. Now the sale value is 900. So the profit which will be calculated, the book profit will include an amount of 900 minus 81, 819. On this, the MAT will be applicable. So in the year when this was reclassified, this 900 will not be considered in book profit. In the book profit in the year 2024, we will consider 819. Is this example clear?
Yes, ma'am.
Yes?
Yes, ma'am.
Fine. So the depreciation as well as the revaluation, both will be in. Yes. So therefore, you have to be very, very careful in case the question appears in this particular fashion. If that kind of question appears, you will have to account it in this particular way. Yes or no? Any doubt? Any questions that you have?
Clear, ma'am.
Clear?
Yes, ma'am.
Everybody clear?
Yes, ma'am.
Okay. Okay. Now, beyond this, if there is, let's say, revaluation on financial instruments, whether that is also to be ignored, answer is yes. But if there is any notional gain or loss on financial instruments, then that is not to be ignored, because what they say is to ignore only for plant property and equipment and investments, not for financial instruments. So that will still be considered. So any adjustments which are only specified are to be considered. Beyond that, you will not consider any adjustment. Is this clear? So what we will do is, in the next class, I will give you a question. I will upload that question prior only. You are required to solve that question and then come for the live class. Right? That will be on the MAT calculation with respect to the IndAS compliant company. With this, we'll stop here for today. If you have any questions, I'll be happy to address. Otherwise, what I will request you is to please revise this particular topic in detail. Clear?
Yes, ma'am.
Okay. Was it difficult?
No.
No? Okay. So thank you so much, and I'll see you in the next class. Please solve the question. I will be uploading on the portal. Please solve it. So in the next class, we will be discussing that particular question. It will give you a practice also. Okay. Thank you so much.
Thank you, ma'am.
Thank you.
Thank you, ma'am.
Yes.